Hi, this is Tony D'Amico, founder and managing partner of Fidato Wealth, and thanks for joining us today for this webinar titled ESOP Success Strategies, Optimizing Swagelok Stock Ownership. So thanks for, again, joining me and Dave Flagle as well, who's a lead wealth advisor at Fidato Wealth and a certified financial planner and a CPA. So we'll both be presenting this webinar today. And we're really excited to give this webinar because Swagelok has just an incredible offering in their ESOP. And it's one of those plans that we're very familiar with and experienced with. And there's a lot of great information in this webinar to help you, again, optimize your ESOP plan and the planning decisions around that to help you be prepared for the future and your future goals. So before we jump into the webinar, I'll do a little housekeeping items, and I'll kind of first start off by bringing up our disclosure on the screen. That's there for you to read if you'd like. But I guess the one thing that I wanted to emphasize is that we obviously don't know like your specific financial circumstances, what your goals are, what your ages are, how many people are in your household, other financial factors and assets that you have. So you shouldn't take what we're providing you today as direct financial advice to implement. Again, because we don't know your financial circumstances. So it's really important to either consult a financial advisor or conduct your own due diligence. And then just a little bit about Fidato Wealth before we jump into this webinar. We're a boutique wealth management firm based out of Cleveland, Ohio, and we have clients in Ohio, North Carolina, South Carolina, Texas, Florida, and a few other states as well. We are an independent fee-based registered investment advisor, and we have an obligation to put our clients' best interests first above all else. It's called the fiduciary duty, and it's the highest level of care that the law defines. So that's really the core of Fidato, and what we do is being a fiduciary to our clients, and we're proud of that because not all advisors are fiduciaries. We do have 98% client retention, and we work with families spanning 3 generations. So we have some great clients that we work with and have worked with for quite some time. Another part of Fidato Wealth that makes us unique is we believe we provide unparalleled wealth management. So yes, we do provide investment management for our clients. We do provide financial planning as well, but a level above that is wealth management. And that's really putting together all the different pieces that are important to a client beyond those 2 items. And that includes things like tax planning, risk protection, estate planning, and other wealth planning to really ensure that our clients' needs are fully addressed for the long term, so we help them accomplish what's important to them. Our team. So we're really proud of our team at Fidato Wealth. Being a boutique firm, we really have a highly skilled team that has some great core competencies. So you can see what some of our internal designations, licenses, and credentials are. So we have certified financial planners. We have several certified public accountants. We have investment advisor representatives. We have insurance specialists. We have folks that have masters in these different areas, as you see in business and personal financial planning, accounting science, and some folks that specialize in advanced financial planning and even compliance. So we're really, again, proud of the team that we have. And in addition to internal resources, our goal is to be our client's quarterback, really their wealth manager. And that includes overseeing external professionals as well. So we work with some of the best tax advisory firms, estate planning attorneys, insurance specialists, trustee services, and other areas that our clients might need. Our mission is to understand our clients deeply, bring clarity and comprehensive strategy while creating peace of mind for them and putting the client first always. We accomplish our mission by providing deep expertise to deliver comprehensive wealth management. By providing intimacy, our goal is to know our clients either as good or better than they know themselves and know what's important to them. And then discipline. We provide discipline by following through and delivering on our promises. At the conclusion of this webinar, some of you may have questions on how to take advantage of the planning opportunities around your ESOP plan, and may decide to take some steps to improve your financial well-being. So we'll share with you how to request that consultation at the end of the webinar. All right, so I'm going to turn this over to Dave to review the agenda and the Swagelok ESOP plan.
Great. Thanks, Tony. Really excited to be here to talk about Swagelok's ESOP plan and really the great benefit that it is to Swagelok's employees. So here's the quick agenda for the webinar today. So first, we'll just start talking about this ESOP plans in general, and then we'll jump into specifics related to Swagelok. We'll talk about Swagelok's performance versus the S&P 500, then the specific details of Swagelok's ESOP and some important things to know. Next, we'll talk about benefits of stock ownership, followed by some financial planning and tax considerations to review. We'll look at Swagelok's one of your 401k statements, a hypothetical 401k statement, to just so we know where exactly everything is at. And then we'll finish the webinar with a case study. So, taking someone through this general process of identifying gaps and opportunities and how you could think through a potential situation. So first, we just wanted to take a moment again to talk about just ESOP plans in general. So ESOP plans really provide an incredible benefit to employees. It's no cost to the employee. Employer is contributing money on your behalf to the ESOP plan in an appreciating asset in employer stock. And that really helps employees really grow your wealth over a long period of time. Again, assuming it's an appreciating asset, which, Swagelok, his company has done really well, and it's definitely an appreciating asset. And then the last bullet is just really ESOP plans help to align interests. So as an employee, you have skin in the game per se. You have employer stock, and so that can be a motivating factor in helping you to really work hard and do a good job for Swagelok, because ultimately that's going to lead into the bottom line and help you to continue grow your wealth. It's also important to note that ESOP plans in general are very uncommon. There's approximately 6,200 ESOP plans in the US and about 10.75 million companies in the US. So if you look at it as a percentage, that's really 0.06% of companies offer ESOP plans. So very small, less than 1%. And so being at Swagelok and the fact that it does have an ESOP provides you, again, with a great opportunity and a lot of benefits. And it's hard to find elsewhere. So first, next we'll jump into maybe looking at Swagelok's stock performance versus the S&P 500. And for those of you who don't know what the S&P 500 is, it's an index that tracks the largest 500 companies in the U.S. stock exchange. And it's often the best index to use, or most commonly used index, I guess, when comparing stock performance. So first, we're going to start with looking at Swagelok's performance over various periods of time. So if we look at Swagelok's performance as of December 31st, 2022, the 6 months ended. So think of from July to the end of the year of 2022, Swagelok's stock performed 7.9%. Next, if we look at really 12 months ended, so just think of calendar year 2022, Swagelok's stock performed 15.10%, which is great. And finally, if we look at the 10 years ended December 31st, 2022, so basically from 2012 to 2022, Swagelok all in had overall performance of 295%. And that's not annually, right? That's a gross number, but annualized, that would be around 29%. Now, the question we have is, all right, how does that compare to how the stock markets have done as a whole? And that's where we bring in the S&P 500 and its performance. So first, maybe looking at the 10 years ended, so from 2012 to 2022, you'll see S&P 500, its performance was 226% compared to the 295% of Swagelok. So obviously Swagelok did about 25% better in that period. Also, an important thing to note and look at would be during 2022, S&P 500 actually lost 18%. And so while Swagelok stock performed positively 15%. And 2022 is a very difficult year, and only two asset classes performed positively. But as you can see, Swagelok stock did very well during that given year compared to the market as a whole. So, you know, thinking about percentages can be confusing for people, even myself. So I always like to translate things into dollars. And so, if we look at translating into dollars in a hypothetical situation, let's say you had $500,000 back in 2012, invested both in Swagelok stock, and then maybe the S&P 500 as well. 10 years later, those values are now going to be 1.4 million, almost 1.5 for Swagelok stock, and then about 1.1 million for the S&P 500. And so what you can see is over a 10-year period, that's a $350,000 difference, which is pretty substantial and can really be beneficial and impactful for you and someone in approaching retirement, in your retirement.
Dave, there was a couple really good points that that you made. So number one is, yeah, this is an incredible offering and benefit that Swagelok offers, and not many companies offer this. So we can kind of, we have a really interesting vantage point because we work with, several folks at Swagelok and other large companies too, as well, that have great either an ESOP or other executive benefits or other things. But this is, not common, and the stock has done really well. So the great thing is it's created some planning opportunities for folks at Swagelok. And obviously too, people might have different levels of participation in the ESOP plan based upon their position. So there's definitely some variation there as well. But overall, just an incredible plan and rare. So yeah, just wanted to talk about those couple items.
Yep. So next, we'll talk specifics about Swagelok's summary plan itself, so your retirement plan, and really related to the ESOP. But before we jump into the ESOP specific points, I think it's important just to outline a few key points related to what Swagelok contributes on your behalf to your retirement. There are three different components that Swagelok can contribute. So there's the employer match, which they will match 50% up to 4% of your contribution. There's also a variable contribution, which can be up to 3% per year. And then there's, of course, the ESOP contribution, which is the focus today. And that ESOP contribution will be 5%. And so all in, Swagelok can contribute up to 10% of your salary towards your retirement. Again, we're building off of a lot of things we said before, but Swagelok provides a really amazing retirement package and savings plan for its employees. And so you should feel very lucky to be at an employer that contributes so much. And I just wanted to point out, if the employer match, again, is 50% up to 4%, if you're watching this webinar and you're not contributing 4% to your 401k, literally click pause, log on to Fidelity, and start contributing 4%, because you're leaving free money on the table with the employer match. And so, yeah, just be sure you're at least doing the 4% in order to take advantage of the benefit that Swagelok's providing to you. So really the focus of this webinar, right, is for the ESOP plan. And so from your table of contents, there's really four main parts of your summary plan description that talks about that, and that's outlined here. We'll talk about on page 13, you have your ESOP account, which gives you specifics about the plan and basic information. Page 17 of accessing your account will give you information about withdrawals and diversification. Page 23 about leaving the company, implications there, and what happens with your ESOP shares. And then page 33 is a timeline for distributions. And so again, we'll touch on each of these points, but in later slides, but these are the main sections of your plan document, which will give you information about the ESOP plan. All right, so starting with page 13 in your ESOP account. Um, so first, Swagelok contributes 5% of your pay to the ESOP. The contributions to your ESOP happen once per year, and it's based upon the December 31st stock valuation. And we'll talk about it a couple other times, but the valuation happens twice per year. These contributions are immediately vested 100%, meaning once it finds its way into your account, if for whatever reason you need to leave the company, you're able to take that money with you. As I mentioned, the stock valuation happens twice per year, and that has implications that we'll talk about later in the webinar related to diversifying and transferring funds. And really, the ESOP plan is a qualified plan, meaning it's all pre-tax dollars. And so, what we've seen is that when we know tax planning is going to be really important for you, um, oftentimes you can have a very large ESOP plan balance as well as a large 401k, and none of those dollars have been taxed before. And so, in retirement, taxes will be your largest expense. And so, our job as advisors is to really try to minimize the amount of taxes that you would pay. And so, we'll talk about tax considerations later on and things for you to be looking out for and possible solutions to reduce your tax bill in retirement. All right, next talking about accessing your account. So, in terms of withdrawals and valuations are based on the most recent stock price. There are two election periods that you can make to diversify your shares, and you'll see here the two main areas are in May and June election period, and then in November and December election period. And we'll talk more about those on the next slide, where we look at the diversification table. And really, you'll see here, and we'll jump into in the next slide, this diversification chart on page 20 and 21 really highlight a lot of the main considerations when for diversifying in your ESOP plan. And so we'll talk through those specifics. It's also just important to note that once you diversify your shares, you cannot reinvest the amounts back into the ESOP. All right, so I would probably say this slide is the meat and the potatoes of the webinar, and so we're going to spend a good amount of time here just to make sure that you understand what exactly is going on and how the different levers that can be pulled and what you're able to do to diversify your ESOP. So this table describes how you're able to diversify your ESOP shares and to what levels. So first, we'll just look at the age column here. It's important to note that your ability to diversify out of your ESOPs, that means selling your shares, is the amount that you can diversify is dependent upon your age. So if you see the different age brackets there, prior to age 55, there are certain considerations. And the age 55 and 56, 57, 58, and 59 and older, again, all have different percentages that you can diversify, which you'll see here. So you'll see at age up to age 55, so less than 55, you can only diversify up to 20% of your ESOP in a given year. And it's important to note that you're able to diversify 20% for the entire year, because there are two election periods. You can choose to do 10% the first election period, which is May and June, and then 10% on the second election period, which is November, December. You can choose to do the entire 20% in the May and June election period. The important thing to remember is just that the percentage you see here is the total amount that you can diversify for a given year. Next, the diversification option shows you what happens to your diversified ESOP shares. So in age 55 or less than age 55, your shares will get exchanged into your 401k, and then they'll be invested there. As soon as you get older than age 55, you have some different options that are available to you, including rolling it over into an IRA or receiving cash payment, which is subject to applicable taxes and penalties. Lastly, we have the election period and valuation. Kind of mentioned it before, but there's two election windows for you to decide whether or not you want to diversify your shares. May and June is the first one, and November and December is the second one. And the specific dates, as you know, are announced and are emailed to you for so that you can enroll and make those elections. And the valuation for each of those periods of time, again, is based on the most recent stock price. Okay, so leaving the company. So if for whatever reason you have to leave the company, a question is what happens to my shares? And it's actually pretty simple. Your shares will get automatically transferred to your 401k. And just as I said multiple times before, the stock price, is dependent upon the timing of the separation. So we'll look at the chart here at the bottom just to provide some more clarity. So assuming you were to leave the company from January to June 29th, the stock price is based upon the prior year, December 31st value. If you were to leave from June 30th to December 30th, the valuation would be the June 30th of the current year. And finally, if you leave December 31st, the price used to determine your ESOP value would be the December 31st, the current year value. Next, timings of these distributions. And so it's a little bit of a reiteration of the valuation piece. So if you leave anywhere between January 1st to June 29th, the share price is going to be based upon December 31st of the prior year. And the processing date is the new piece of information here, in that these are the dates, again, that you will be able to receive those distributions. And so it's important to note that, if you separate April 1st or April 1st through 30th, the processing date isn't until May 15th. And there can be a delay in the processing date based upon the valuation that needs to happen with the shares. Again, that happens twice a year. And again, if you're leaving later in the year, after June 30th, the valuation is going to be based upon the June 30th value of the current year. And you'll see the processing date of October 15th. Actually, for the first segment there, if you leave between June and August 31st, the first processing date is until October 15th, again, because the stock gets valued twice a year, and you need time for that new valuation to get in place before they're able to process that payment. And finally, the third separation date of December 31st based upon December 31st value, and the processing date of April 15th the following year. Okay, so the details we reviewed so far relate to your Swagelok's specific plan. And here we'll kind of transition into talking about just some considerations for owning stock and owning employer stock, that it'll be important for you to understand and think about these things and how it applies to your specific situation. So first, pros, which is potential for significant gains in your portfolio itself. High concentration in employer stock. I'd say it has high risk and high reward. So in the situation where employer stock performs very well, such as Swagelok, that's a very positive, right? You potentially have a lot of your assets in Swagelok stock. And when it does well, your portfolio as overall is going to do significantly well also. And we talked about this before, but there's a sense of connection to your company in stock, again, because your interests are aligned. You have skin in the game. So some negatives or cons related to having a high concentration of employer stock would be that there's a lack of diversification. Again, high risk, high reward. There's also stock specific risks. So you can have business risks that could relate directly to the industry itself. There's market risks. So large market movements as a whole. For example, again, in 2022, market did very poorly overall. Again, Swagelok did great during that period of time, but maybe a company could have been in a market or in an industry that didn't perform well, and it would move with the market, and you would have risk associated with having a high concentration there. And then there's always regulatory risk with change in laws and how that can affect an individual company and ultimately its bottom line and stock performance. And ultimately as well, if you're working at Swagelok, which you are, and you're receiving both your paycheck from them, so your living expenses as well as your retirement benefits in the employer stock are both tied into the same company. And so, in the event that something were to happen at Swagelok and stock wouldn't do well and there were layoffs, then you have the potential of both taking a negative hit in your retirement account with Swagelok stock going down, and then also maybe a potential loss of income. And so there's always those types of risks related to owning employer stock. So what and I have found is probably one of the most common questions related to having employer stock and a high concentration in company stock is, hey, how much should I own? And I'd say probably with most things in financial planning and in life, the answer is it depends. There's a lot of considerations to answer that question that need to be taken into consideration to answer the question. So your age, your time until retirement, your other investment assets, your risk tolerance, so your ability to take risk, all of those factors contribute to help us to answer, I guess, that question of how much you should own. Generally speaking, when you're younger, you're able to take on more risks. So that means I'd say you're in a wealth accumulation phase, that you are able to take more risk because you have more time to recover in the event something negative were happen to your portfolio. And again, generally speaking, as you approach retirement, there's a transition. There should be a transition from wealth accumulation to wealth preservation. So it's the idea that you no longer need to take the risks in order to help grow your assets. We need to focus and put more concern on really preserving what you have and reducing risk. One simple test we like to start with when someone asks this question is the sleep test. So, plain and simple, how are you sleeping at night? If you're not sleeping well at night, that might be an indication that you are taking too much risk, and maybe diversifying a little bit of your holding could be a consideration. Now, on the flip side, maybe you sleep great at night, and you're not worried about the risk associated with your portfolio and your Swagelok stock. But that doesn't necessarily mean that you have the right amount of stock anyway. Uh, there's really a next level, next test to take to see whether or not you have the optimal amount of employer stock. That's what we call a concentration test. And so, again, generally speaking, when we work with clients, we use 20% as a barometer of concentration in a portfolio. And so we say if 20% of your overall investment assets are in a specific holding, then there could be some considerations for diversifying some of that holding. To calculate this concentration percentage, you want to take your ESOP value divided by your overall investment assets, and that gives you the percentage. The percentage of your ESOP is of your overall assets. What are investment assets? Some of your investment assets are 401ks, their ESOP value, your IRAs, Roth IRAs, brokerage accounts, and large cash holdings. So you want to take into consideration all of these values when calculating your concentration. And it's important to, again, look at your overall asset allocation when considering your ESOP and your Swagelok stock and how much you have, that you want there to be an appropriate level of risk, and you want to have the appropriate level of different types of assets to reduce the risk in your overall plan. All right, so we'll look at a few slides of different groupings of people, and we'll see where you're at and maybe some considerations and strategies to consider given the certain category. So first, we're going to look at if your age is 55 or younger. So if you're younger than 55, we're bringing back the diversification chart, and we're seeing, all right, here are your options if you're younger than 55. You can diversify up to 20% of your ESOP annually. Again, that is 20% annually, get in both the election periods. So 10% the first, 10 the second, 20, 0, etc. And if you were to choose to diversify, the funds would then be exchanged into your 401k. All right, so some strategies to consider if you fall into this category. So we still want to look back and lean on the sleep test and the concentration test, right? We want to make sure that you're sleeping well at night, and we want to see what level of concentration you have in that stock compared to your overall portfolio. If you do, if you are over have concentration greater than 20% in the ESOP stock, there could be an argument and consideration to diversifying the max annually. Again, that'd be 20%. And when thinking about diversifying your stock, um, it's important to note that you're going to continually receive shares, right? You're granted shares annually, and so even if you were to diversify 20% of your holding, you're not able to diversify 100% of it, right? So you're still going to be receiving some more shares every year. And really, the first opportunity, if you made the decision or had the desire to sell 100% of the stock, the first time you'd be able to do that is age 59 and a half. But up until that point, you will continue to receive shares, and you ultimately can't diversify 100%. And as I previously stated, the amount you will sell will get transferred into the 401k and then placed into your investment allocations there. All right, next we're going to look on the flip side. So if you are older than 55, that's where we fall down into the below highlighted categories, right? So if you're age 55 to 56, you can diversify up to 25% of your ESOP holding. Age 57 to 58, you can do up to 50% of your account balance in a given year. And then age 59 and older, you're able to diversify up to 100%. And again, the options that you have, once they diversify, you can exchange them into the 401k and invest them in the options there. Or there are considerations to potentially rolling the funds over to an IRA or receiving cash payment subject to applicable taxes and penalties. Just a quick note on the subject to applicable tax and penalties and the cash payment. Generally speaking, we discourage actions that would create penalties. So oftentimes there's a better solution than pulling funds from a plan and incurring penalties. And so just make sure you're understanding all the considerations if you were to choose that type of option. All right, so strategies to consider. All right, we're going to go back to the sleep test and the concentration test, right? How are you sleeping? What percentage, and then what percentage of your assets are in the stock itself, right? As we went over, your diversifying options are increased to 25% and 50%. And then the 401k investment allocation is important. So even having maybe diversifying some of the funds into your 401k, maybe that's the right decision. But you also want to make sure that the investments within the 401k itself are appropriate. You could diversify your ESOP shares and put into your 401k, and it could be sitting in cash. I know it goes into a default option, but if if maybe we're trying to time the market and you're putting it in cash, then that might not be the right opportunity or the right answer for you. Again, having overall appropriate asset allocation within your 401k as well is very important. And then again, as you approach 59 and 59 and a half, you're able to diversify up to 100% of your Swagelok holding. And if you're looking to take a lot of that risk off the table, then that could be the right answer for you. It's not the right answer for everyone. You don't have to sell 100% once you get up to age 59. But that would be what I would say, again, a shift from wealth accumulation and taking more risk to wealth preservation, to reducing your risk and ensuring that your assets can last you through your lifetime. All right, so tax considerations. Taxes are, again, one I think of the largest expense for retirees. And so it's important for us to understand the tax considerations of the various decisions that you make. So first, we're going to start with exchange and rollovers. So exchange, that term is used when talking about moving funds from your ESOP to your 401k. That's not a taxable event. A rollover is putting money from your 401k into your IRA. Again, that's not taxable. Really, taxes come into play when you get into distribution. So if you were to take a distribution from your 401k or into your or IRA into your bank account, that is when you get taxed on that income. All right, reading your statement. So this is a fictitious example. This isn't anyone's personal information. Numbers have been changed, but essentially, this is what your 401k statement will look like. And you probably already know this, but it's worth pointing out that there's no separate statement for your ESOP plan. Your 401k balance as well as your ESOP balance are both found on your 401k statement through Fidelity. And specifically, your Swagelok stock value is going to be found right here, along with the associated shares and share price. Okay. So we've talked through a lot of details about the plan itself and maybe some considerations uh, based upon your age range of, all right, should I diversify or should I not? Next, we're going to jump into just a case study with John and Jane Smith. John and Jane are not clients. They are fictitious people. But some of the details that we talk about in terms of maybe goals, needs, and concerns, they are common through a lot of our client base and are representative, I think, of maybe some of the goals that um, some of you might have. So we wanted to walk through, how we would use the Swagelok and diversification information into a case study. So first, when we talk with clients, we talk about their goals, their needs, and their concerns. This really needs to be the foundation of where you start when creating a financial plan is understanding these three things. Financial planning is not only about investment management. Yeah, that's a part of what financial advisors do, but goals, needs, and concerns are at the foundation of what we do and what we need to understand in order to create a plan, an accurate plan, and wonderful plan for clients. So some goals that John and Jane Smith wanted to achieve: they wanted to achieve financial independence for retirement, maintain a current lifestyle, have money to travel. They're considering the purchase of a second home. They want great experience with their children and their grandchildren. They want to give to charity in the most tax efficient way. Next, their needs. They need to figure out what to do with their Swagelok shares. They need to determine what else needs to be done to retire. They want to ensure that their money is appropriately invested. They want to ensure their estate documents are properly structured for us and our heirs. And some concerns that were expressed, so potential market recession and the impact it could have on retirement plans, paying too much in taxes in retirement. And they've heard of Roth conversions, but they're not quite sure what exactly they are and if it's right for them. So we then translate these goals into, I guess, put dollars and cents to these goals to help us understand whether or not their current situation can, in terms of their investments, any other income streams can help provide for them to achieve all these goals. So, you know, there's needs, wants, and wishes. We have living expenses, healthcare expenses, travel, $20,000 for college to help for a grandchild. In the wishes column, we see second home, extra costs. We always plan for long-term care events in case that were to happen. Now, John and Jane, here's a quick snip of their investment assets. They have a brokerage account at Fidelity, about $100,000. There's their Swagelok 401k, about 1.2 million. Their ESOP plan of 1 million, and then an old employer plan of about 150,000. And in looking at investments, John and Jane, it was important to note that these investments that they had were largely pre-tax. Again, the IRS wants to take some of this money that has not been taxed yet, and so tax planning is going to be really important for them. Again, to minimize the amount of tax that they're going to pay in their lifetime. Now, when looking at the specific holdings of their accounts, we first look at, this is the current section here. We look at the combination of stocks, bonds, and cash that they have. They're currently sitting around 82% in stock, and then the remaining amount in bonds and cash. And really, that would equate to projected return of 7.53% and a standard deviation of 15.01%. Now, standard deviation, some people might know, but some people might not. It's a measure of risk. So essentially, the higher the standard deviation, the more risk you are taking in your investments. So the job of an advisor is to allow you to take the right amount of risk for the right amount of return. We never want there to be outsized risk for in under uh, non-outsized returns, essentially. So when looking at a current allocation, John and Jane had really two options there to take a little bit less risk, or really take less risk in both situations. One was looking at a more moderate growth portfolio, which is around 60% equity and 40% bond, which ultimately reduce their projected return, but also significantly reduce their risk in the standard deviation. Really, there's a moderately aggressive portfolio as well, taking a little bit more risk here, about 75% equity and the remaining in bonds. Again, projected return 7.82% of that historical returns of that asset class, and then standard deviation of around 14. So this is where they were currently at. And really we want to view it within the filter, right, of what decisions they need to make from their ESOP plan. So again, one, we look at the concentration test. We noticed that their Swagelok stock equated about 40% of their overall investments. And again, we look at 20% as the threshold there for us to really consider diversifying. Through conversations with John and Jane, they decided that they wanted to reduce their risk and shift from wealth accumulation to wealth preservation. And John's 60 years old, so his option, he could diversify up to 100% if he wanted to, and that's ultimately what he decided to do. He decided to diversify 100% of the holding and roll it over into an IRA in order to be invested in a diversified allocation. For them, the diversified allocation meant a 60-40 portfolio, which compared to the current risk they were taking is 25% less risk than they're currently taking.
I mean, Dave, that's a pretty substantial reduction in risk, right? So reducing risk by a fourth by 25% and keeping a similar rate of return, right? I think that's substantial, right? And that's not right for everyone, like you mentioned. That's ultimately what they decided to do. And I think the helpful part of reviewing a case example is we can kind of talk about this in context a little bit. But like for them, right, they realized that they didn't need to try to hit a home run each year. They're trying to hit basically maybe singles and doubles, to use a baseball analogy, right? They realized that they already benefited tremendously from having this, and for them, they wanted to protect it. But again, not everyone does that, right? They might take some risk off the table. So each scenario is a little bit different.
Yep.
But just wanted to expound on that, Dave.
Yep, perfect. And as previously discussed and mentioned, tax planning is a really important piece of planning for John and Jane. Specifically, Roth conversions is something that they would benefit from. And so what we look at here, just to point your attention to, we look at lifetime, the taxes you will pay over your lifetime. And the goal is, again, to reduce that amount to as small as possible. And so without doing any Roth conversions in their picture, they're projected to pay between $3.2 million in taxes over their lifetime. Now, implementing Roth conversion strategy, which in essence is to try to convert assets into Roth IRAs now at a lower rate so that you don't have to pay a higher rate later. And that you do it strategically every year. And by implementing a Roth conversion strategy, it reduced their lifetime tax bill to about 2.9 million, which ultimately result in a projected lifetime tax savings of $350,000. And now it's important to note that, this isn't going to be an exact figure. Again, this is John and Jane are fictitious people. But when we do these for clients, even that number is not going to be exact on. It's a general direction based upon the information we have and the assumptions of current tax rates and what the new future tax rates will be. that we'll be able to save, I'll say, a significant amount of tax dollars for them over their lifetime. Next, at a high level, we look at Jane and John's cash flow over their lifetime. And this, a lot going on in the statement, but essentially it's looking at income and expenses every year going into the future. And really, some of the points that we'll look at for John and Jane are, looks like they're electing to receive Social Security at age 67 for these amounts here. But there are some decisions that you can make to help optimize the amount that you get for Social Security. One of those could be to defer to a later date. That could be age 70, which will give them a higher benefit. Again, those are decisions that you review to see what's right for them. Maybe they decide not to defer and they'll continue to receive at age 67. But there is work to be done to help them decide and figure out what is the best Social Security filing status. And ultimately, in the plan as well, we look at expenses. And it's important to note that we like to be conservative in planning and that expenses are inflated. So healthcare is inflated for 5.8% every year, which might seem pretty large, but it needs to be that way in order to help account for the high cost of inflation, I guess, related to healthcare. And then we use a historical 3% for the remaining expenses in the plan. And so really, after you input all the data, what does this actually mean for John and Jane? Ultimately, we look at a confidence rating, confidence zone in rating and probability of success for them that currently, that when they came in, they were sitting at 63 or 69% rather probability of success and confidence rating, and specifically looking at their composite return of their portfolio and the standard deviation. Right, this is them holding on to the stock and not selling it. But what we looked at for John and Jane, there are certain strategies to implement. So we want to reduce the risk in their investments. And again, they elected to sell their ESOP shares. Not everyone had to do that, but they elected to. And to diversify, they wanted to implement the Roth conversion strategies and also optimize their Social Security filing so they can get the highest benefit, and resulted in a higher probability of success for them in their plan for them to achieve their goals. So really, to summarize a lot of the details of their situation, the different gaps and opportunities that we identified for them, that they had a highly concentrated stock position. Then the solution was to create an investment strategy to reduce the risk while maintaining similar expected rate of return. Tax strategies were not being utilized. Roth conversion strategy would give them lifetime tax saving about $350,000. Social Security was not optimized. So optimizing their claiming strategy would give them a lifetime benefit of about $110,000. Nothing that was shown on the screen, but oftentimes estate documents are old and outdated and need updated. So, an estate planning process initiated to help them to draft those with the help of a qualified attorney. They had taking unnecessary risk in their insurance, in the insurance area of their life. So there's the independent review of their umbrella policy, which is an opportunity for them. Then ultimately wanted a comprehensive and coordinated plan, which was not in place. So walking through the process with them, provide the understanding, clarity, and strategy by providing the comprehensive plan to help them accomplish everything they wanted to accomplish.
Yeah, there's a lot of great takeaways, Dave, that you reviewed here. One of them, obviously, is you reviewed the Roth conversion strategy, which I think is really important, right? Because the ESOP, typically whenever someone diversifies out of that, that's all pre-tax money, right? So
Yep.
without this strategy, right, they're going to have required minimum distributions when they're 75 years old if it all stayed in the IRA as pre-tax. And what we see a lot is that it's going to push someone up into a much higher tax bracket, where their tax bracket might be in the 30% range in the future, where maybe now, maybe they're in the 22 or 24% bracket. And I think that's just a really important strategy is because that's a big implication of having the ESOP plan is it increases the amount of pre-tax assets. And if you don't do anything about it, it creates a tax nightmare later in life. So tax bracket management is a huge part of this, as Dave described. And it's not just looking at your tax bracket like this year or next year, but looking at your tax bracket, over your lifetime and being very strategic on when to fill those lower tax brackets to take advantage of the Roth conversions. Because that's, in essence, what we're doing is we're saying, okay, well, you have room in your 22% tax bracket, perhaps earlier in retirement. Well, let's do Roth conversions then. So that way those funds are in Roth IRAs that will grow tax-free and you can take income from them tax-free, and they're not subject to required minimum distributions for the Roth IRA owner and a spouse beneficiary. So very important, where if we didn't do that, more stays in that pre-tax bucket, which creates a lot of excessive taxation later. And again, each Roth conversion strategy could be a different estimate of tax savings, again, based upon the current tax law and the fact that the tax laws will sunset in 2026. And the tax code changes. So the software knows what all those changes will be. It knows what the tax law is, right? Tax laws could change. But sometimes Roth conversion strategies can project a $500,000 savings to a $2 million savings to kind of what we're showing here. It really ultimately depends. It could be even higher. And I think this also does a great example, Dave, of just the power of compounding good wealth planning decisions. So in this particular case, they were thinking of claiming Social Security at a certain age, but we took a look at different claiming strategies and then what age do they need to live to for that claiming strategy to become profitable. So we call it the break-even age. And then based upon their anticipated life expectancies, we calculated that by optimizing their claiming strategy added a little over $100,000 to the financial plan. So a lot of these decisions aren't just, they typically have cumulatively multiple six-figure implications over the life of the plan. Obviously, right, there's risk with any decisions, right? Ultimately, no one knows exactly how long they're going to live. But these are some common strategies that come along with the ESOP plan. And then, there could be a spouse that also has perhaps some benefits, maybe stock options or other things that kind of creates to the, we call it tax bracket management, but it's also tax sequencing, trying to control how much you pay in taxes in any given year. So, I think this is a great kind of representative example, Dave, of how you put all the pieces together for someone that has the ESOP benefits. So thanks for reviewing all that. So in conclusion, wanted to make the complimentary consultation available. So again, for those of you that might have questions about your benefits or how to maybe optimize some financial planning around your ESOP benefits and how to put these pieces together, we'd be happy to offer a complimentary consultation. And a great way to do that is to reach out to us directly. If maybe you already work with one of our advisors, or maybe you were referred to us by someone that works with one of our advisors, or you can reach out to Dave or I. Our contact information's on this slide as well. So you can pause that and see our email addresses and our intro links to schedule an intro call to discuss the consultation. So we're happy to do that and provide value and answer any questions that we can. And then lastly, we have our website for, if you want to check out our website, we have a great learning center. We have a YouTube channel, and we also are posting webinars on our website as well. So that concludes today's webinar. Thank you guys for joining us very much. And we look forward to being of service if you have any questions. Thanks. Have a great day.